Good afternoon, everyone, and welcome back to the Moneycontrol live stream. You're watching markets with Santo and CJ. A very volatile session on Dalal Street today ahead of the weekend. Well, it seemed like investors were just too, they were refraining from taking aggressive bets in the market at this point of time. But it seems like as we are heading towards the close, bulls are going to be the dominant force. If you look at the Nifty and Sensex, they're higher by about 0.4%. At this moment, the mid and small cap stocks have also recovered mostly. The mid cap index is now in the green. So clearly, after 4 days of lackluster session, a lot of losses, it seems we are going to end the week on a happy note, Santo.
Well, you do seem cheerful, CJ, but let me tell you, I think more than any aggressive buying, I feel that this could have to do with a slowdown in selling. In fact, EPFR's Cameroon brand was on CNBC TV 18 today, and he was saying that overall there's been some moderation of outflows of FPI money from India over the last week or so. So probably that could partly explain why market has been able to hold on. But CJ, unless the situation overall globally improves, I can't see how stock prices here are likely to post big gains.
That is true, Santo. I mean, clearly, of course, institutional activity as such has reduced quite dramatically. It's not only that FPI outflows have decreased, but even DII inflows have also come down quite significantly. So clearly, at this point of time, it seems like we are at at an impasse in the market. It seems like we are probably in suspended animation, where the market is now waiting for the earnings season to unravel itself, and then maybe take a view on where we are headed over the next 6 months. So that said, now quickly dive into some of the stocks that Santo and I had on our radar today.
Federal Bank is the first one on our watch list. Now, what a strong set of numbers there, CJ. Overall, Federal Bank has been one of the steady performers in the banking pack. It had fallen to close to about 85%, 85 rupees a month back. Since there, it has rallied about 17 odd percent. It's been showing good strength, and I think probably some bit of the buying would have been in anticipation of the strong set of first quarter numbers that the bank posted. Its return ratios are almost the best in nearly 25 quarters, and you're seeing a across the board improvement. Net interest margin is at 3.22% compared to 3.15% a year back, and 3.16% during the fourth quarter. Return on assets 1.1%, and return on equity is at 12.7%. But the best part here, CJ, is that gross non-performing assets has also reduced from about 2.69. It's come down to 2.69% from 2.8% year ago, and also the if you look at the other income, which is the fee income, it's up by 73%. That's a real big jump. So I think things are definitely looking up for Federal Bank.
Well, Santo, clearly this has been one bank in the private sector space which has won over investors over the past few years. Clearly because of course, the management has been very steadfast in managing the asset quality situation. Even when the asset quality situation was hanging over the banking sector, Federal Bank was actually one of those banks where these issues did not crop up in a very meaningful way. So clearly, I think the asset quality story has played out there. What, of course, now the bank is trying to do is get aggressive on the lending side, and clearly you can see that in the way their risk weights have increased. They are now becoming very aggressive. But the only concern, Santo, from the Q4 number, and that is probably something the market will also like to take note of, is the fact that slippages have actually gone up on a sequential basis, and this is largely being driven by retail the retail loan book. Basically, retail slippages stood at about 205 crores in the first quarter, whereas the overall slippages number jumped over 400 crores in the quarter. So clearly, I think there is some incremental stress coming on the lending book, and I don't know whether given the way the economy is shaping up, given the macro headwinds, given the fact that inflation itself is going to create issues for a lot of retail borrowers out there, it is prudent to be so aggressive going out in a market like this.
No risk, no returns, CJ. Probably
well, I don't know. You can't. That is, banks are the last place. Banks are the last place you want to say that risk hai to ishq, or ishq hai is the last place that you want to hear banks probably. That said, let's quickly move on to the next stock, and that is Star Health Insurance. Well, this is one stock that has taken a lot of beatings since the time it got listed last year.
And for good reasons, CJ.
Yes, definitely. I mean, there were, of course, good reasons for that. But I think now, with the sort of correction that we have seen on the counter, it just makes some sense for, value investors to probably jump into this counter. We're already seeing a good rebound in the stock in the past few days. probably led by some HNIs and some retail investors doing some bargain hunting in the market. Now, of course, one of the major concerns for Star Health, of course, was the fact that life insurers could probably be allowed to, get into the health insurance space, and everybody started getting, very panicky over that. But if you look at what analysts have to say, they believe that the inclusion of life insurance companies into the health insurance space probably will not lead to that much of an impact on market share for a company like Star Health compared to maybe, if there was some other segment. Even in the past, when, life insurers were used to provide certain health securities and health, insurances, they never had a meaningful market share compared to the actual players or non-life insurers out there. So that is one thing that, clearly market will probably get out of. Apart from that, if you look at ICICI Securities, they believe that the retail health, space is actually a very high growth space with a high entry barrier as well. So therefore, it will be very difficult for companies to come in and take away from Star Health the market share that it has very meaningfully gained from PSU health insurers. So that is, I think, this is one stock which could probably come in for some sort of a relook from value investors out there.
Well, I will throw a line which you mentioned 2 weeks back when I was talking about ICICI Lombard. The recent rebound in the stock could be more a case of reversion to mean, probably. The stock has been beaten so much that now
Santo,
investors are seeing some kind of value. Now 2 years, CJ, this company has been reporting huge losses, right? That is something that would put off most investors in this kind of a market. But that said, probably maybe the market is sensing some kind of a turnaround. My question to you, CJ, is that it's a monoline business, right, in that sense. So clearly the entry of other players should kind of dent its operating margins.
Well, Santo, the only thing is that it's very difficult to get into this business. According to analysts I spoke to, they feel that health insurance is also much like probably life, and maybe more than protection insurance like life insurance, a pure play life insurance. Health is something that requires a lot of brand value, right? In terms of convincing people to buy health insurance, because this is something that people don't do generally, right? Nobody actually buys health insurance. I mean, people buy life insurance only with so much difficulty. So I think what ICICI Sec's argument here is also the fact that the company has already made a meaningful inroad here, built a brand. It will be very difficult for somebody new to come in and take that away. I mean, mind you, Star and Care are actually only the two retail health insurers who have gained market share over the past 5 to 10 years in this market. Nobody else, even the incumbent players before them, were not able to do that. So I think that is something, it's the execution that is probably in favor of Star Health compared to anything else.
Well, NALCO is the next stock on our watch list. Now the stock has taken quite a bit of a beating. It had touched a high of about 130 in April when aluminium prices were close to their record highs, but since then it is nearly halved, and it's down to about 70 rupees. Now valuation wise, the stock is looking attractive. It's available at close to one-time book, but more than that, what broking firm Antique says is that one of the strong points of NALCO is that it's among the cheapest producers of bauxite and alumina. And now if you look at the prices of alumina as compared to spot aluminium prices, at 14.5% of spot aluminium prices, alumina prices are below the 5-year average of about 18%. So there could be some bit of reversion to mean. Secondly, even though there's fears of some kind of oversupply from China, overall LME inventories are running low, and given the energy crisis in Europe, many smelters won't be restarting operations very soon. That means that you're looking at a tight aluminium market. Antique has a buy rating on NALCO with a price target of 105 rupees.
Well, Santo, I think the argument for a tight supply market or tight supplies for aluminium has been there since January, right? I think that was what was the contributing factor to the surge that we saw in global aluminium prices and alumina prices as well. I think the only thing now that is different is the fact that there are now concerns over demand. It's not so much about supply, but demand itself has now come under doubt because of fears of a global recession. We have seen what has happened to the Chinese economy. The Chinese Q2 GDP was much slower than what a lot of people out there were expecting. So clearly, for me, I think this is one space that there is still a lot of potential for downside instead of upside. You could see things getting worse before they get better for a company like NALCO, because we have only seen only a month-long correction on the stock. So there could be possibility of some time correction as well on this counter. And the only way I could see sentiment going on the reverse direction, probably becoming bullish, is if Chinese economy rebound. We have already seen talks of a $200 billion to $1 trillion stimulus in China, especially in the infrastructure space. So if Chinese demand comes back, then maybe we could see a reversal here. That will be my point of view. That said, one stock where, another stock which is, today it seems like we are all about value investors somehow. Another stock that has taken a lot of beating.
That is how you define value again, CJ. I think we differ on that probably.
Possibly. Well, let's talk about Latent View then. This is one stock that is almost, 50-60% down from its record highs. One of the best performing stocks of last year. The IPO was subscribed, 338 times when it came out. So clearly, it was the story of the year last year, but now it is one of the disasters of the year. But I just feel that the disaster is a bit unfair on the company. If you go by some of the fundamentals that are out there, it is still one of the best plays in the data analytics space, one of the only listed companies in the data analytics space. And I think probably it deserves the, that rarity premium that you would know that Avenue used to enjoy or Jubilant Foodworks used to enjoy. I think Latent View deserves that premium in terms of valuation. And apart from that, generally it will tend to be clubbed with the IT space as well. And then you have the argument, if there are recessions coming, if there is a slowdown coming, then IT spending will come down. But I think data analytics is a little different, Santo, because this is something that is part of the core activity of any technology company. Not only technology, I mean, you have retailers, you have department store companies, you have other companies who depend on data analytics on a day-to-day basis, and therefore this is not something that clients can cut spending on. So I just feel that the threat to earnings is much less here than probably in traditional IT companies, and therefore there is an argument that investors could start looking at the stock from a longer term point of view.
CJ, I was just looking at the price chart of Latent View.
Yeah.
There's a lot of fanfare around the stock, 330 times oversubscribed, all that. Stock lists within 2 days, it shoots to about 700 rupees. And from there, it's just been one way down. It's almost now less than half of, its peak price. Now, see, I take the point that Latent View is in a very niche space and there are no other listed, firms providing data analytics services. That said, I'm then still surprised why the stock has not managed to find takers. So my theory here probably could be that smart money would have definitely tried to sniff out whether it does make sense. They would have looked at some of the unlisted players, what are the kind of margins there and what's the kind of opportunities, potential, how competitive the market is, and maybe what they found wouldn't have been all that great. This is just a theory. I don't know. Otherwise, I'm just trying to explain why, when the stock has fallen so much and you're seeing bargain buying in many stocks which have fallen quite a bit, you're not seeing that in Latent View. So this is just a theory. I'm not very sure about that. That could be one reason why the stock is still languishing and perhaps could continue to do that, languish for some more time. Look at the institutional holdings in the stock. That too has in fact, shrunk. In fact, it's been steadily reducing.
I think they were probably booking profits. They have been booking profits from the top level for a long time
in 3 days and then just fleeing that low. Well, okay.
Well, I think the only, for me, I think Latent View has, taken the beating that it has taken largely because of having that technology sector tag on its head. We have seen what has happened to tech stock. I mean, leave alone India. Look at what has happened to tech stocks out there in the US, where they were the high growth, bets of 2020, 2021, but since then have fallen almost 70 to 80%, and in some cases even 95%. So I think generally in the initial wave of selling, a lot of the tech stocks, I mean, you take internet platform names like IRCTC, InfoEdge, who are actually profitable, by the way. They were high growth companies with good earnings. They themselves have taken almost 45 to 50% correction. So for me, I think the initial wave of selling was driven by this factor, where the market sentiment was so negative. But now when that selling is exhausted, I think going forward, investors are going to take a much more well-rounded view of the company, of the sector, and maybe there they would find that the earnings momentum is just too strong to ignore.
Maybe, you may have a point there, CJ. And the last stock on our watch list is Syngene International. Now, the stock has been in the news over the last couple of days. In fact, the company has signed a 10-year agreement with Zoetis for licensing its biologics drug for treating osteoarthritis in dogs. Now, the exact value of this deal is still not known, but what Syngene has said is that it hopes to make about $500 million over the next 10 years, mainly through the success of this antibody, which is called Librela. So, and if you look at the quarterly earnings of Syngene International over the last 4 quarters, there's been a steady uptick, and this is also one of the reasons why the stock, after hitting a high of about 670 odd, has been pretty much stable around those. It's seen some dip, but over the last 1 month, again, it's rallied by about 17%.
Right.
This is one company, one of the leading players in the contract research and manufacturing services space, and it looks like the stock could outperform in the short term.
Well, Santo, clearly, I mean, I think probably not only in the short term, but even from a long term point of view, the CMO space within the pharmaceutical sector has been one space that has still held on to some of the gains that it made in the 2020 rally in the pharma stocks, and largely because, of course, a lot of global manufacturers out there are trying to diversify their supply chain. We have all heard about the China Plus strategy that a lot of MNCs have been adopting, and I think probably Syngene benefits. Maybe this deal also is a sign of that happening, and therefore I think probably you could still bet that this will be a stock that could perform very well over the next 2 to 3 years going ahead.
Well, Batliwala and Karani has a buy rating on the stock. It says that at 43 times, roughly 43 times 1 year forward and 35 times 2 year forward, the stock is reasonably attractive, and BNK has a price target of 700 on the stock.
Well, that's it, Santo. Let's quickly take a check on the market, and we are, it seems, heading towards the day's high as we look, head towards the closing bell. If you look at the Nifty, it's higher by about 0.8%. So it seems there's some covering of short positions as well, Santo, ahead of the weekend. I think probably the shorts don't want to carry on their short positions over the weekend. You don't know what might come over the weekend and in the US markets later in the evening. Apart from that, even the mid-cap space is doing quite well. The Nifty mid-cap 100 index is higher by 0.9% at this point of time, while you will soon see the Nifty small-cap 100 chart. I think that is higher by about 0.4%, but underperforming the mid-cap and the large-cap space at this point of time, Santo.
Well, next week also the focus will continue to be on earnings, and CJ here is going to tell us which are the key companies that we should be keeping an eye out
Santo,
for.
HDFC Bank, clearly tomorrow the big bank number is going to come out. It's going to be the biggest banking earning. Of course, Federal Bank has got us kick-started on that space, but HDFC Bank will be the one to watch out for. Apart from that, on Tuesday, HUL will come out with its earnings, followed by Ultratech. You have ICICI Bank will also be reporting its earnings on Saturday. So it will be an earnings heavy week. A lot of names from the mid and small cap space will also be starting to report their Q1 numbers. So it will it is possible that next week could be more about stocks than about the macros out there, because already we are not seeing too many changes or developments on the macro space. So clearly earnings is something that will dominate. Apart from that, on the macro front, clearly the ECB's monetary policy next week on Thursday will be something to watch out for. Will we get the first rate hike from the ECB? That is something that the market is betting on. We have already seen that the euro-dollar parity has been broken. Euro moved lower than $1 yesterday. It will be important to see what sort of commentary comes in from the ECB chief. So those are the two things to watch out for next week, Santo.
Well, thanks, CJ, and with that, it's a wrap on this edition of Market with Santo and CJ. Thank you for watching, and have a wonderful weekend ahead. And do share your comments about this show in the feedback section below.
And guys, before you get out of this live stream, do continue to follow us on social media links at the bottom of your screen. And I don't need to say this, stay tuned to moneycontrol.com and the Moneycontrol app for all your financial coverage. We'll have a great weekend. Have a great 10 minutes of trading session left, and we'll catch you again on Monday.